In this lesson, we are going to talk about understanding credit cards. So what is a credit card? A credit card is a plastic card that you can use to access a line of credit that has been established in advance. So a credit card, if you remember from the very first lesson, is open-ended credit. A person can borrow up to an established credit limit. The credit limit is a maximum dollar amount that can be borrowed. And again, credit cards are open-ended, not closed. Credit card interest. This is the rate in which the interest is charged, is referred to as the annual percentage rate. This is the cost of credit expressed as a yearly interest rate. Interest is charged each month. The balance is not paid in full. So a minimum payment. So to prepare for her first semester of college, Miranda purchased a new computer for $1,000 and textbook for $500. She spent a total of $1,500 on her credit card, charging 15% APR. How much would Miranda pay in interest if she makes the minimum payment? So if she makes full payment in the first month, she has zero interest. She's going to pay the full price of $1,500. If she makes partial payment for 1 year, she's going to pay $125 in interest, totaling $1,625. And then if she makes the minimum payment of $30 for 11 years, her interest paid is going to be $1,400. So her computer and books are actually going to cost her about $3,000. A minimum payment is due each month the card has a balance. So credit cards equal helpful management tool if managed responsibly. And that's the key word there, managed responsibly. Develop a positive credit history. They're a convenient payment tool. They're protected from unauthorized charges. Credit card safer for online shopping and credit card bonuses. Develop a positive credit history. Credit cards can have a positive or negative impact on your credit history. Follow these positive behaviors. Pay your credit card balances in full each month. Pay credit card bills on time. Be conscious of how credit cards affect your credit history. Check the monthly credit card statement for errors. Convenient payment tool. It needs, you don't need to carry cash. It's useful for emergencies, often required to hold a reservation. Know not to overspend, because it's easy to do with a credit card. Protect yourself from unauthorized charges. Maximum liability is $50 for unauthorized use and $0 if the credit card is stolen or reported before the fraudulent use. If the credit card number is used fraudulently, but the credit card itself is not used, you're also $0 liable. Make sure you report lost or stolen cards immediately. Check your monthly statements. Safer for online shopping. What's the difference between a credit and a debit card? More protection against fraud, less liability for unauthorized credit charges. Credit cards are safer than debit cards, and money is not connected to your bank account or depository institution account. Should you choose debit or credit at point of sale? Point of sale is those little machines at the store that you swipe your card through or you insert your card in. If you pick credit, a receipt must be signed. It's optional if the purchase is under $25. Potential benefit is extra liability protection from fraudulent charges. If you pick debit, you must enter your PIN number, and its potential benefit is option to withdraw cash from your depository institution account for no fee. Additional benefits, rewards, cash rebates, airline miles, warranties for items purchased, travel insurance, may charge additional fee or higher interest rates for these rewards, and carefully evaluate the benefits and make sure that they outweigh the cost. Advantages and disadvantages of credit cards. How many advantages can you think of? How many disadvantages can you think of? They're a convenient payment tool. They're useful for emergencies. They're required to hold a reservation. They're able to purchase a big ticket item and spread out payments. Their protection against fraud. Opportunity to establish a positive credit history. Online shopping is safer than using a debit card, and possibility of receiving bonuses. The negatives: interest can be costly when the balance is revolved. Additional penalty fees may apply, tempting to overspend. If not used responsibly, it will have a negative impact on your credit score. So credit card offers. Credit card issuers are required to disclose the terms and fees of the credit card in an easy-to-read format, and this is called the Schumer box. So this would be the terms and fees of the credit cards, all listed out in what is called a Schumer box. Important term there. So here is an example of a Schumer box to the right. Credit cards may charge many different types of interest rates. So the very first one up at the top is your annual percentage rate for purchases. It's the interest rate paid for purchases. Multiple interest rate may be listed. Final interest rate may depend on credit worthiness of the application. So if you look on the Schumer box here, we have a 12.99%, 13.99%, and a 14.99%. Depending on your credit score, you could have the high one or the low one. Next one is an introductory rate. Usually a credit card will offer an introductory rate. This is a APR that may be charged, usually increased after the introductory period ends. So it might say 0% financing for 6 months. That would be considered a introductory rate. Not all credit cards have an introductory rate. How does creditworthiness impact your APR? It will influence if a person receives a credit card and the APR. APR will be higher if the person has a poor credit history. So fixed versus variable rate APR. A fixed rate cannot change during the period of time outlined in the credit card agreement. A variable rate may change depending on other factors such as economic conditions. APR for balance transfers and cash advances. It's a balance transfer is the act of transferring debt from one credit card to another. Cash advance is withdrawing cash from an ATM using a credit card. And fees may apply even if the APR is 0. Penalty APR and when it applies. A penalty APR rate is charged on new transaction if penalty terms in the contract are triggered. Make a late payment, go over your credit limit, make a payment that is returned, and do any of the above on another account that you have with them. How to avoid paying interest on purchases. Pay your bill in full by the due date. Minimum interest charge is typically 50 cents to $2 per month. And then the last tip there is to explore the Federal Reserve Board website, and they're going to give you tips for credit cards. Next, we have fees, setup and maintenance fees. We have an annual fee. Sometimes this doesn't necessarily happen. This is a yearly fee that may be charged for having a credit card. Setup fee is a fee for opening the account. Participation fee is a monthly fee for having the credit card. An additional card fee is a fee to have a second person on the card. So why would a consumer choose a credit card with an annual fee? Because they might get better benefits. Transaction fees are balance transfer fees, cash advance fees, and other. And then penalty fees are fees that are charged in addition to the APR. So late payment fee, over the limit fee, and the return payment fee. How to calculate your balance. Credit card companies use one of several methods to calculate outstanding balance. And then lastly, the loss of introductory APR. If a card has an introductory rate, this is the area